Hello everyone, this is the part 2 of chapter number 7 of CMT level 1, moving averages. Before watching this video, make sure to check the part 1. In case you haven't, then I've linked it in the description box below. In the first part, we basically saw what is a moving average and what are the different types of moving average. And we also saw the different types of strategies using moving average. Now we have to start with directional movement. Now what is directional movement? Think about it for a second. So directional movement was given by Wells Wilder. So almost everything in this chapter is given by Wells Wilder. Wells Wilder is a very important. He has made some really important contribution to the industry, right? So what did Wilder really do? Wilder compared the stock's trading range for one day with the trading range on the previous day to measure trend. So what he really did was he measured the range of today's day, the current day with the previous day, current day's candle with the previous candle. So he tried to do that. That is what is known as a directional movement. Now what is my directional movement? Let me explain that for you. This is my previous day and this is my current day. So is my current high more than my previous? Yes. My current candle's high is more than my previous candle's high. In that case, it means it is a positive directional movement. Okay. Why is it a positive directional movement? Because the current day's high is more than the previous day's high. In that case, it is a plus DM. What is plus DM? It means a positive directional movement. Alright. Now, what is a negative directional movement? So, if this is my previous candle and this is my today's candle, today's low is lower than my previous candle's low. In that case, this is my minus DM or my negative directional movement. This is my negative directional movement. Okay. So I hope you understood what is a plus DM and what is a minus DM. Extremely simple. If today's high is more than my previous day's high, then that is giving me a positive directional movement. If today's low is lower than my previous day's low, that is going to give me my minus DM. Now I'll show you a very simple flow chart and try to make it if you want to remember. This is again given by Wilder. Okay. So why am I making you write all this? Because it is very basic, but before the exam you can just revise from these notes. So make sure that you're drawing it along with me. Wilder's directional movement we have already discussed. So if this is one day's candle and this is one day's candle, so the low of today's candle is lower than the previous day, so this means there is a minus DM. Clear? Now this is the previous day, this is today's day. The high of today is more than my previous day, so this is a positive DM. Alright, and then we have this, the low and the high both are inside the range of the previous day. So in this situation there is no directional movement at all, right, because the candle of today is inside my previous trading range. And if my high and the low both are more than the previous day, in this situation there is going to be a plus DM on the upside and a minus DM on the downside. Now which one will I consider? Whichever is more. If the plus DM is more, you will consider that. If a minus DM is more, you will consider that. So if the high is double, then you will consider high. If the low is double, you will consider the low. So I hope you understood this. This was very, very basic. Take a moment to note it down and then we will discuss. Alright. So that's what my Wilder's directional movement. I have explained the flow chart as well and how you basically calculate the DM, which is my directional movement. Okay. Now let's actually come to the indicators. So there are various indicators which are developed because of this DI. So because Wells Wilder invented the DM, which is my directional movement, various indicators are basically constructed on this. One such indicator is my DMI. What is my DMI? DMI is my directional movement indicator. So there are various DMIs, right? There are various directional movement indicators, and a directional movement indicator is basically based on the DM only. It is a line which is generated. We will now also go and see the practical aspect of it, and we will see how it looks on the chart. Before that, let me just quickly tell you what a DMI really is. So a DMI indicator, I'll just show it to you on the chart first. Let's go on power grid. Okay, directional movement index. Let me remove my moving average. So this is my DMI. Can you see my DMI? This is my, I'm removing my ADX. Let's just do plus DI and minus DI. Plus DI is my blue line, minus DI is my orange line. Now we know what plus DI and minus DI is, right? So the blue line is my plus DI. So if you look at this area over here, in this area, let me just mark it, in this area, the plus DI is more than my minus DI, right? In such situation, the market went up. Now, here, if you see, just a second. If you look at this, the plus DI is again more than my minus DI, so there is a pump over here as well. So that is how you can use. When the plus DI is more than the minus DI, then the price trends upwards. When the minus DI is more than my plus DI, the price trends downwards. So I hope you are able to understand this, what I just explained. Okay, let me just erase this. Okay, this is my DMI. So now how do people actually use the DMI? The way I have explained, that is how they are going to use. Right now, whatever I explained, right, you know how to use that. So that's how people are going to use their DMI. Now what are the various ways using how you a person can use DMI? Let me go on my daily chart and I'll try to explain it in a better sense. So the first thing, let me read what's given in the book only. The second indicator, negative direction indicator, ATR. We'll also come to ATR. Okay, so we have already discussed the first point which is given in the book, which is that whichever DI is more than the other DI, the trend is in that direction. So we have already discussed that when plus DI is more than the minus DI, the trend is upwards. When the minus DI is more than my plus DI or DM, whatever, then in that situations my downtrend is more prominent. So that is the first thing which we had to discuss. Okay, the second thing, the book states that the minor crossover that occurred, it suggests that the direction of the trend is now sideways. So when a crossover occurs, or when there are both the DIs or both the DMs coincide, or come together, that is a place where you need to avoid trading, because that signifies congestion, and that signifies that the trend is currently in a range or it is sideways in nature. So if you can if you look at the chart over here, you can see in certain areas where, let me just mark, look at this. Here you can see that it's a congestion zone, and you can see that the price also stuck in the same range, right? Again over here, this is a congestion range, so the price also didn't really move anywhere, it was in the same range. So whenever two of the DIs have a crossover or they're very much nearby, in that congestion zone you're not supposed to trade. Okay, that's what they're talking about, crossover. The third thing is standard divergence techniques are valid in DMI. Now, what is a divergence? Highest peak exceeded the earlier peak, but that was not confirmed by DI. Alright, so now the third way of using a DI or a DMI index is by the divergence method. What do you understand by divergence? The price is going up but my DMI is going down, or my DMI and my price are giving opposite signals. That is a divergence. Whenever you want to take a trade, it should be confirmed by the DMI as well as your price, right? So if you look at this, let's say if you look at this, the price is creating higher highs and higher lows. But what about the DMI? The plus DMI is more than my minus DMI, but it is not creating higher highs and higher lows. Here it stopped creating higher highs and higher lows. Even the price was still creating higher highs and higher lows. What happened after that? The price came down. So this shows a divergence, right? Because the price was still continuing creating higher highs and higher lows, whereas your positive DMI stopped creating higher highs and higher lows, and in fact it gave up somewhere over here. So that gave you a signal that the strength is not that strong. Okay, so that is how you're going to use in the case of divergence. So I hope that is clear. Moving on, the DIs can be used to create a directional index DX. This is used to create the average DX called the ADX line. Now ADX is also a very important indicator. Let me just add it. You remember the pink line which I removed? That is only my ADX line. So let me just add my ADX back into the thing. So my pink line is basically my ADX, okay? Average direction index. So this is my ADX. Now what is my ADX? ADX is basically created using both the DIs only. So the ADX is calculated on the basis of my both DIs only. Okay, so the ADX indicator is valuable in determining when to apply a moving average. ADX is basically showing you the momentum or the strength of the movement. So that is how you are going to use an ADX in order to basically. Okay, so what exactly is ADX? ADX is the smoothed value of the DX. Okay, the DX is basically, it's given in a smoothed value, and there always ADX moves in the direction of the price. Actually ADX basically gives you the momentum of it. Now let me explain how. ADX, a rising ADX indicates increasing tendency to trend. A low ADX means that a flat or a dull trend or losing its momentum. So if the strength is strong, your ADX is going to rise. If the it's not a strength, it's the momentum actually. If your momentum of the strength is not so strong, then your ADX will be falling. Now let's try to understand the ADX indicator without the help of the DI and DX, and let me just do this. Now let's try to understand this. Look at this. Here my price is going up, my ADX is also going up. So this shows me that the strength is really strong, right? Here my price is going up but my ADX is going down. That shows me that the price is going up but the momentum of the trend is not so strong. So then what happened? The price came down. So you always need to enter into a trade only when the ADX is also confirming. When the ADX is also confirming that the momentum is really strong over here, in that situations you need to enter. Otherwise you should not enter. So I hope you understood how I use this. If you look at this again the okay, here in places over here when the ADX is stagnant, you should not enter because you know that there is no momentum. So if there is no momentum, then there is no movement in the market and the price is remaining in the same range. Now here the ADX is also going up and the price is also going up, and then what happened? After consolidation the price went up again, right? So here that is how you are going to use your ADX. I think that is clear. And then now we have something known as the ADX peaks and troughs. So you can also use the ADX peaks and troughs in order to trade, or in order to, let's say, confirm your trade. How are you going to use that? Let me show you that. Alright, so I hope ADX is also clear to you guys. So ADX is basically it determines the momentum of your trend. Okay, so that's about it. Now let's begin with envelopes. Now, what are envelopes? Let's talk about that. Envelopes, bands, channels. Now these are the things which we'll be studying about. So first, let's read about what are percentage envelopes. So one way of creating this type of band is to use percentage envelopes. So the percentage envelopes method, it is also known as a percentage filter. Okay, so it was developed to attempt to reduce the number of unprofitable signals. So why do we use percentage filters? We use it because you want to ignore or you want to avoid the false signals, right, in that cases. So it is a very popular method. Okay, and where do you usually use the envelope? So the percentage envelopes, you usually use it in situations wherein there is crossovers. Percentage envelopes. So whenever you have a moving average system where crossovers and stuff like that happens, in those situations you are going to basically use this. So the envelope then becomes the trigger for the signals when it is crossed by the price rather than when the moving average is crossed. Again, let's read what exactly is a envelope. It is calculated by taking a percentage of the moving average and plotting it above and below the moving average. So a percentage filter or a percentage envelope basically takes the moving average of the moving average, and it is basically displayed above and below the moving average. To understand it better, let's just plot it on a graph. Let me check if it's there on trading view. Okay, yeah, I thought you need to pay it in order. If you look at this now, moving average is over here. You can see the moving average, right? Let me just for a second just remove this. Now if you look at this, if you look at the moving average, it's just 20 moving average, and there are two lines which is above and below. So this is what is an envelope. So how does an envelope helps? An envelope basically helps you see. Right now I'm showing it in a crude oil, so let me just go to my Nifty 50 index and how my envelope really looks. Okay, this is how my envelope usually looks. Let me make it big. I'm going on my daily chart for you to understand it better. Give me a second, it's loading. Okay, until then let me just read. The envelope then becomes the trigger for signals when it is crossed by the price rather than when the moving average is crossed. The percentage used in the calculation should be large enough that it encompasses most of the oscillators. It should be small enough to give signals early as well. The percentage must be determined through experiment because a slight difference in percentage can cause a considerable difference in the performance. So what is the percentage which you are going to use? So right now you can see this is a 2010, right? So that is how you have to basically go through a thorough experiment before you choose a particular percentage of your envelope. So if you look at this, this is how an envelope looks. It is drawn above and below your moving average. Okay. One of the major problems with fixed percentage envelopes is that they do not account for changing volatility. During a sideways trend, when volatility usually declines, the price action can be continued with a relatively narrow band. Okay, so this is how you basically use a envelope, and I personally do not use envelopes to trade, but you can just keep it in mind because it can be tested in your exam. So that's about it with our envelopes. Moving on to channels. Now channels is this is a double N over here, that's just a typing error. So channels are something which are used very much in your trading journey, right? Because channels are one of the most important things to keep in mind whenever you are trading. Before coming to channel, let me just quickly first discuss the bands and then we'll move to channel. So you must have heard about the most famous band, which is the Bollinger Band. Bollinger Band is something which is usually used by most of the traders in their in their early trading journey. I'll just give you a little bit overview about Bollinger Band, and then we'll be going into the charts and we'll be seeing the examples of the Bollinger Bands. So there are two principal ways to measure the price volatility. One is the standard deviation. Just a second. One is the standard deviation about a mean or moving average, and the other is the ATR. So, you know that using these two you can calculate the price volatility. Now, how do you use? So, there are two ways to calculate price volatility. You either use the standard deviation to calculate the price volatility, or you use the ATR, right? So, what does the Bollinger Band use? The Bollinger Band uses standard deviation. Keep that in your mind. This can be in the MCQ format in your question. So, Bollinger Band uses standard deviation to calculate. Alright. So, Bollinger Bands, how do you calculate a Bollinger Band? Think about it for a second. Listen to me carefully. I am explaining you how to calculate a Bollinger Band, and I know that you must be wondering that why do you even have to learn about all this, even though it's all calculated by the computers, because you need to know how did the values of the Bollinger Band come in the first place. So, first calculate a simple moving average of the prices. Bollinger Bands uses SMA, simple moving average, because most calculations using standard deviations use a SMA. Next, draw bands a certain number of standard deviations above and below the moving average. For example, Bollinger's standard calculation and the one most often seen in public chart services begins with a 20-day simple moving average. Two standard deviations are added to the SMA to plot an upper band. The lower band is constructed by subtracting two standard deviations from the SMA. The bands are self-adjusting. Okay, so how do you basically calculate a Bollinger Band? It's very simple. You first simply plot a normal SMA or a normal simple moving average, and when you add 2 times the standard deviation, you get the upper band, and when you subtract 2 times the standard deviation, you get the lower band. 2 times the standard deviation is added and subtracted twice above and below, and you get the bands respectively. So that is my basic calculation of Bollinger Band. If you are having a hard time remembering the formula, rewind the video, listen to me again, pause it and note it down. Okay. So that is how you are basically using a Bollinger Band. And what usually happens is that the price oscillates between my Bollinger Bands. Let me go to the trading view chart and show you some of the Bollinger Bands. I'm removing my envelope and adjusting the chart size. Let me just adjust it. Reset price scale. I'm removing my stochastic as well. Why is my okay, let me go to my Bollinger Bands. Okay, you just have to search BB, you will get it in your trading view. Now look at this. This is my Bollinger Band. I'm just removing my background over here, and basis. Basis is also not required. What is basis? Basis is the middle SMA which I was talking to you about. I told you that a SMA is plotted and above and below Bollingers are plotted. That is my basis, the basis. So my basis was the 20 moving average. Whatever I want I can use. Usually people use the 20 SMA only. So I have unticked the basis over here, the middle line, which is the SMA, using which the Bollinger Bands are calculated. So in this case I am using a 20 a 20 SMA. So my upper band is going to add the 2 standard deviation and my lower is going to subtract the 2 standard deviation. I have removed my basis and the background because I don't want the shaded part. Now if you look at this, let me just untick my moving average for a second. This is how my Bollinger Bands look like. If you observe something, the price usually most of the times is oscillating between the two bands. The price is usually resisting or taking the support from the Bollinger Bands as well. So this is one of the most important thing to notice over here, that my price is oscillating between both of my Bollinger Bands. Okay. So the standard Bollinger Band around 20 period moving average with bands at 2 standard deviations. Of course, both the length of the moving average and the number of deviations can be adjusted. Theoretically, the plus and minus 2 standard deviations should account for approximately 95% of the price action about the moving average. Okay, however, it could mention just a second as a chart, the price action seems to. This is because the moving average is replicating the trend of the prices adjusting for them, while the band is describing the normal upper and lower limit. So even when the price is oscillating away from the moving average, The upper and the lower limit is given by the Bollinger Band. If you look at this, the price is usually not going outside the Bollinger Band. The moment the price went outside the Bollinger Band, it came back in. The moment it went down, it came back in. The moment it came down, it went back in. So the price usually is between my Bollinger Bands. Okay. So that's about it. That is my Bollinger Band, and I hope you understood how we can use Bollinger Band. You can use it in your trading journey, and also how it is calculated. A simple moving average, two standard deviation. If you add, you get the above line. Two standard deviation. If you subtract, you get the below line. So this is my Bollinger Band. Now we come to Keltner band. Keltner band is again another band which we are going to use. So what is Keltner band? So the Keltner band, a little bit of introduction about it. It was given by Chester Keltner. Okay. So Chester Keltner, Chester Keltner is a very important person, and he has given some major contribution in the market of commodities. So he wrote a book which was how to make money in commodities, right? This was a book which was written specifically on the commodity market. If you talk about India, we have the MCX, which is the commodity market, and Keltner basically described about his band or about his Keltner bands in that book. Now, how do you basically calculate a Keltner band? Again, to construct Keltner bands, first calculate the typical price. Now, what do you understand by typical price? Close plus high plus low. You are basically adding all the prices. You are adding the closing price, you are adding the high price, and you are adding the low price, and then you are dividing it by 3. When you do so, you are basically getting your typical price, and then calculate a 10-day SMA of the typical price. After you get the typical price, you are calculating a 10-day simple moving average. Calculate the band size by creating a 10-day SMA of high minus low or bar range. Again, hold on. I know it's a bit confusing, but sometimes calculations are asked in the exams, and that's why I'm making you guys learn this. Even I don't think it's necessary to learn this. Why? Because it is given by the computers automatically, but then you need to keep it in mind. So first you are going to calculate the typical price, which is high plus low plus close, and divided by 3, and then you calculate a 10-day SMA of that. Alright. After doing that, you are going to calculate band size by creating a 10-day SMA of the range. What is the range? High minus low. High minus low basically gives you the range. The upper band is then plotted on the 10-day SMA of a typical price plus the 10-day SMA of a bar range. The lower band is plotted as the 10-day SMA to the typical minus the 10-day SMA of the bar range. Okay, very clear. And this is also very much simple to the ATR only, and sometimes they are also referred to as the ATR bands. So Keltner bands are also known as the ATR bands. ATR bands. So whenever I'm talking about ATR bands, you need to keep in mind that they are also known as the Keltner bands. How did you calculate Keltner bands? Very simple. You are taking the typical price, which is the open plus high plus close, and divided by 3, and you are calculating the SMA of that. Okay, and then you are going to find a 10-day SMA. Alright, whenever I'm saying SMA in Keltner bands, I'm talking about a 10-period SMA, and then you are going to find a 10-day SMA of the trading range. What is the trading range? It is basically high minus low, and you are going to add that to your typical price and plot an upper band, minus that to a typical to the typical price, and you are going to plot the lower band. That's how you get the Keltner band. Okay, let's just quickly plot the Keltner band in your trading view and see that as well. Let me just remove this. Keltner channels. Okay, it's loading. Let's just wait for it to load. Oh, if you look at this now, again it's used the same way, but then it takes a typical price, whereas the other one did not take the typical price. You can see that more or less it's the same thing, but the calculation of Keltner band is a bit different. It takes the typical price and it also plots the 10-day SMA of it, and it adds the and then it calculates the SMA of the range and add the typical to the range and subtract the typical and the range, and you get the upper and the lower band. Don't go into the detail of it, you just need to have an idea of how to calculate it in case it gets asked in the paper. And ATR bands, whenever you're talking about ATR bands are also called as the Keltner bands. Okay, so we are done with our Bollinger band, we are done with our Keltner band. Now what you really have to do is that after watching this video, go to on TradingView, go and backtest Bollinger band, backtest Keltner band, backtest the Stark band, and see which one suits you, which one works for you. Something can work for you and it might not work for me, something can work for me and it might not work for you. So it totally depends on your own perception, something which suits you or not suits you. The same strategy followed by, let's say, Warren Buffett, if I use the same strategy, I might probably not make money, or maybe I might. So it's trading is something which is very, very subjective in nature, and it is very personal in nature. So something that works for me is not necessary that it will work for you. So you need to backtest excessively, and you need to see what really suits you, what suits your psychology and your experience, and then you need to work for it. Anything in this course, in fact everything in this course or everything in my videos, whatever you're learning, you need to backtest them and you need to see what exactly suits you. We're not just giving this exam just to pass the exam and clear it, right? We also want to become better traders. So in that case, you need to put in some extra work and you need to go and backtest on the charts. Okay? Alright, now we're coming to a Stark band. What is Stark band? Stark is an acronym. I hope you're clear with that. So Stark is the full form of the Stark. The full form of Stark is Stoller Average Range Channel. Okay? Stoller Average Range Channel. So whenever they're asking what is the full form of Stark, you need to know that it is a Stoller Average Range Channel, and it was invented by Manning Stoller. This system uses the ATR over 5 periods, adds to and subtracted from a 5 period SMA of prices. So what is ATR? ATR is my average true range. So average true range over the past 5 periods, that is added and subtracted to the 5-day SMA. It produces a band about the prices that widens and shrinks with the change in ATR or the volatility of the price. So what is the advantage of using a Stark band? When you're using a Stark band, the volatility of the index is also coming into account. So it also takes account the volatility, right? So that is something which is extremely crazy because it takes volatility. Just as Keltner bands, the length of the SMA used with Stark can be adjusted with different trading or investing time horizons. I'm not going to show Stark band on the trading view. This is something you can do by yourself. Okay, so we are done with 3 of the bands. Okay, I'll just quickly write down the formulas in the notes. So later on, if you want to revise for the exams, you can see this and you can revise. I hope you are writing all this. So the first kind of band which we saw was Bollinger bands. How are you going to calculate Bollinger bands? Okay, so these are the three ways of how these are the formulas of all the three bands. The first one is the Bollinger Band, where you usually use a 20-day SMA. Two standard deviations are added and subtracted from above and below. Keltner Band is also known as an ATR band, where you calculate the SMA of a typical price and you add and subtract the trading range, right? Stark Band, you have the ATR of the 5 periods, which you add and subtract with 5 SMA. So that's it with my bands. The next concept is trading strategies using bands and envelopes. So what is a trading strategy? How can you basically use it? Think about it. So in line with the basic concept of following trend, bands and envelopes are used to signal when a trend has occurred. While looking at the envelopes or bands, one would think the best to use them must be to trade within them from high extreme to low extreme. Similar strategies of rectangular patterns. However, trading between the bands is difficult. First, by definition, except for fixed envelopes, the bands contract during sideways, dull trend and leave little room for maneuvering at a cost effective manner. Second, when prices suddenly move on a new trend, they tend to remain close to the band in the direction of the trend and give many false exit signals. Third, when the bands expand, they show that the volatility has increased, usually due to the beginning of a new trend, and any position entered in further anticipation of low volatility is quickly stopped out. Bands therefore have become methods of determining the beginnings of the trends and are not generally used for range trading between them. When the outer edge of the band is broken, empirical evidence suggests that the entry should be in the direction of the breakout, not unlike the breakout of a trend line or support level. A breakout from the band that contains roughly 90% of the previous price action suggests that the general trend of the previous price action has changed in the direction of the breakout. And I hope you are able to understand what I am trying to say. The only difference between a band breakout and a more conventional kind, that a band is generally more fluid, because moving averages will often become support or resistance levels. The moving average in the Bollinger Band calculation should then become a trailing stop. So you can use the moving average middle line, which was the moving average, as a trailing stop loss. The other use of the moving average within a band is retracement level for additional entry in the trend established. Another use of the bands is to watch price volatility. Low volatility is generally associated with sideways to slightly slanted trends. Okay, to watch volatility, one should take a difference between the high band and the low band. Bollinger calls this band a bandwidth indicator. A bandwidth indicator is basically the difference between the high point and the low point. Now we come to what are channels. Okay, channels have been described as something simpler than two parallel lines. We mentioned the Donchian channel method that has been so successful, even though it's widely been used for many years. Signals occur with the Donchian channel when the breaking above or below a high or a low over some past period occurs. This method does not require the construction of a trend line. The only requirement is to record the highs and the lows over some past period. In the case of the Donchian channel method, the period was 4 weeks. The rule was to buy when the price exceeded the highest level of the past 4 weeks and sell short when the prices declined below the lowest low of the past 4 weeks. Okay, so whenever the highest high of the past 4 weeks has been broken, then you buy, and whenever the lowest low of the past 4 week is broken, you sell low. This is the base and the core concept of the Donchian channel. Okay, you can go on to TradingView and try to identify what is a Donchian channel, but a Donchian channel basically, I'll just show it to you, it's fine. Okay, let me go to Donchian channels. Okay, if you see the past 4 weeks, 1, 2, 3, 4, the high is not broken, the low is not broken. Let's see this. Okay, let's see this. 1, 2, 3 and 4. In this candle, wait, I don't know if you're understanding. So let's look at these candles. Okay. Now, the moment the lowest low of the past 4 candles is broken, here it's broken, you need to short and look at the dump. I hope you understood. And this is 1, 2, 3, 4. Now let's take these 4 candles. As soon as the high is broken, if you entered, look at the price pump. So that is what is my Donchian channel. Whenever the lowest low of the past 4 weeks is broken, you short sell. Whenever the highest high of the past 4 weeks is broken, you buy. That is my Donchian channel. This is something which we discussed. So now let's conclude the chapter quickly. The basic way the technical analyst makes profits is by identifying a trend in prices and riding that trend. At times, daily fluctuations in prices make it difficult for the analyst to view the basic underlying trend in prices. Moving averages are tools used to smooth this erratic data, making it easier to discern the genuine underlying trend. Although there are various methods of calculating a moving average, the basic idea is to give a summary of the average or normal price history of a particular period. Because the moving averages are based on historical prices, they will be a lagging indicator. So why is a moving average a lagging indicator? Because the signal which is given by moving average is usually lagging in nature or late in nature. However, using a shorter period also leads to more false signals. As usual, when choosing a moving average system, there is a trade-off between early trend reversal recognition and certainty of the trend reversal. The use of envelopes, bands and channels around the moving average can minimize the number of false signals by providing a larger range of price movement before a signal is triggered. Okay. So now this is a very important box which is given in your book in the last page. I'm just reading it out for you. So this is a box which is giving you some trading rules. Here are some key points. So these are some key rules or points you need to remember. Riding the trend is the most profitable use of technical analysis. You always need to go with the trend. Do not go against the trend. Trends can be identified with trend lines, moving averages and relative highs and lows. These are the 3 methods using which you can identify the trends. Always pick a security that trends up and down. Flat or random trends are usually unprofitable. So whenever you're picking a stock or a commodity or whatever security you're trading in, make sure that it has good movements upwards or downwards. Avoid those securities which have a sideways or a random trend. Okay. Be aware of the next longer period or shorter period trends. Always trade with the trend. Trend is your friend, don't buck the trend. Breakouts from support or resistance levels, patterns or bands usually signal a change in the trend. A trend line breakout is at least a warning. The longer the trend, the more important the breakout. So when a trend is really long and then a breakout happens, then that usually shows you that it is going to be real. Confirm any breakout with other evidence. So whenever there is a breakout, confirm it. In the previous chapter we saw how to confirm it, right? Always use stops. Stop losses, protective and trailing stop losses are extremely essential. Do not sell profitable positions too soon, just keep trailing with stops. Do not exit in a hurry, always wait and exit according to your system. Okay. So that's it, we are done with this chapter. In the next video we will be starting with the chapter number 8, which is your bar chart patterns. Thank you.